Today is Tuesday, starting the week already. We do have quite of a interesting, would say, we already had the IPA today, so we still have quite of an interesting scenario going over today, tomorrow, and Thursday. Not much happening over on Friday, but we still have plenty of things happening today, and that's one of the most important days of the week, I would say. So as you know, some of you may know, some of you may not know, today is the CPI day, so the Consumer Price Index for the USA. And why is this one so important? Why this release in particular is so important compared to other ones, and how and what could we trade if it comes above or below what is the expectations? Because we do have quite of interesting scenario at the moment that we're going through, especially because of the last print of the NFP. We'll go through that in a second, so make yourself comfortable. As always, we need to put the risk disclaimer up before starting, but let me just check if there is anyone new here. I do see a new name, so Pre-Prezio, sorry if I pronounce your name wrong, Pre-Prezio, welcome. If you have any questions, feel free to send a message into the chat. Or if you, maybe you're a bit shy, you can just select who you're going to send this message, and you can select the host, that it's going to be me, and that message will come only to me, and I will be the only one being able to see. And then the same goes for everyone else here. But usually, I love to answer questions, and that's always a good time to get the thoughts out as well. So let me put the risk disclaimer up, and we'll have to leave there for a minute or two. And then once that's good to go, we can start the meeting and go for the content. All right, perfect. All right, guys. Oh, good. Sorry, someone just come here. Okay, so basically, the thing logics was the economic calendar will come with everything. So you just click on United States, and that's what you're gonna get. So from here, you can see already that we have a 3% forecast. So forecast and previous are the most important to, it's what you should be looking. So the forecast is 3%, the previous was 2.9%, and that's for the core inflation rate. Okay, now for the normal inflation rate, it's forecasted to be 0.2, and that's month over month, from the previous of 0.3. The core inflation month over month is 0.3 from the previous 0.2. So basically just inverted that to two lines. And the inflation rate year over year from the forecast is 2.8 from the previous 2.7. I would say it's quite of a mixed scenario here when we look at in this sense, but there's no really, where to miss it in a sense for the US CPI. What we're most likely going to see, it's some sort of a mixed release. Okay. Now, what I want to bring attention and why this CPI is so important. If we come to the CME, let me send this link into the chat. Okay, there you go. If we come to the CME, we can see something very, very clear here. That is over 86% priced in for 25 base points cut into September. Okay, I think I've mentioned how to use this tool many, many times, but basically you have the current target rate over here on the top. Just get my pen, not white, and like maybe an orange. Yeah, so over here you can see, the current target rate is 425 to 450, right? And 425 or 450, and the prediction is 86% of the market is expecting that the rate will go down from 425 down to 425. Okay, so that is an 86% probability of that happening. Now, really, really interesting, because that gone like that in matters of microseconds. Okay, and the reason why it's so up high at the moment is because of the previous NFP. Okay, so the previous NFP were below, I think it was like below 40,000 what was expected to be. Okay, so it was, I think the actual number went to 70,000 and the forecasted number was 120,000, 107,000, around those numbers. We can always double check that, but just from the top of my mind, that were sort of the release that we got from the 2 weeks ago. That in mind made the market, that release made the market clearly understand that we will have a cut soon because the labor market is becoming tighter and tighter. And that was what Jerome Powell have been always saying. We want a tighter labor market. So then when we got that, market is pricing a 25 base points cut for October. Not only for October, but if you check on, for not only for September, but if we check on October, there is a 53.6% chance of another 25 base points cut. And if we look on December, there is very, very close, so literally 0.3% of a difference of a no cut in December. So there are expectations of two cuts, 125 in September and another 125 in October, and then bring the rate down from 425 to 450 to 375 to 4. So if that changes, literally 0.4 to one side, then we're going to get a 75 base points cut for September, October, and December all together. So 25, 25, 25. And the rate will come from 425 to 450 down to 350 to 375. Most likely, we will probably get to know if they will have a cut or not tonight. And this is why I say it's so important. It's one of this particular is really, really important because of the CME. It's because of the market pricing, and also not only the market, but also the yields. Let me put this in a 4-hour. But also the yield kept dropping since May this year. Okay. So since beginning of 2025 actually, because everyone sort of had a 480 was the maximum, 385 was the low, and now trading at 425. So yeah, let's really see how this will go. But anyways, so not only the CME FedWatch is pricing, but the yields are also pricing for since beginning of the year a slow but still steady down move into the 10-year, into the rates. Okay, if we look now for the 2 years, so there's a big thing that I actually did a video on that today. Will be out in a couple hours most likely. So if we look the 2 years and the 10 years, so we can just overlay each one like that. I'm going to do it now. So that's the 2 years. Let's go for the 10 years on here, and let's change this chart for line chart. Perfect. So in yellow, we got the 2 years, and in pink, we got the 10 years. If both of them are too different from each other, so right here, we got 10 years at 428 and the 2 years at 370. If that was the inverse, so if the 2 years was at 428 and the 10 years was at 370, basically we would be going into a recession. And that happens, okay? It's not happening right now, but as you can see here, it was happening previously, okay? So if we put something around here, and then I just lock this one as well, I can see that that happened before. Okay. So the 2 years were all the way up to 5%, and the 10 years was at 460%. So that was basically into last year, April 2024. And interestingly enough, if we look for Let me take this off and change it back to a candle. If we look to the DXY in April last year, just like that, we see that there was a big decline, okay, because the market was fearing a recession. So the 10 years were below the 2 years. So the faster yielding was higher than the slower yield. And that was triggering fears of recession into the market. So therefore, what they were doing is they were selling the US dollar. And we can clearly see that right here. So that's the beauty of just sort of understanding in a sense, not too in depth, but understanding the intricacies of between 2 years and 10 years yields, and basically long term and short term yields. Now coming back here, this is why is the most important one. If we get a release that is completely, off the rack, let's say it goes above 3%, the inflation rate month over month goes above the previous. Always important to check not only the forecast, but also what was the previous. Okay, let me grab my pen here. So if this one, the forecasted is 3%, and the previous was at 2.9%, there was no big changes here. Okay, so it was literally 0.1% higher, and that's the core inflation. So yeah, it's excluding food and energy prices. That's great. But now, if we get, let's say, the month over month expectations, sorry, the previous was 0.2% and expectations are now at 0.3%. If this, by any chance, someone is drawing on the screen. Sorry, let me just take this off. If we get that, perfect. So if we get this one all the way, let's say to 0.5 or something, really, really up from forecasted, this will push a lot this guy down. Okay, so this from 86 would become like 50%. It would be like a 50-50 chance, or maybe even 40%. Okay, because the reason is, once we have the inflation rate being above expectation and above previous, then we get an inflationary pressure. And if we have an inflationary pressure, the Fed doesn't like that. So what they will do is they will hold back into the rates again. And if they hold back into the rates again, what we'll do with the DXY? Well, what you guys think it would happen with the DXY? Send in the chat. Let's see if you guys are awake. No answers. Interesting. Let's see. Let's wait. No one. Okay. So if we got an inflation, yes, good one, Zoda. So Zodwa said it will go up. So that's correct. It would go up. And why is that? Now I'm going to be a little bit more picky and try to pinch. Why do you think it would go up? Let's see. It's a pretty simple answer, actually. There's not much around that. But why do you guys think it would, possibly go up? It's quite simple. So I tell you why. When we have something like that priced in, 86%, it's basically saying that the Fed will cut. So if that changes from 86 down to 40%, of course, it won't only change the September, but the October will also change, and the December will also change. Not too sure, and we can't be very, I would say we can't forecast very well how October and December would go, but they would definitely have a difference between now and after, okay? So, but the September definitely will be like to 40% of a possibility of a cut, and this guy on 13% will become 60% of no cuts. Okay. So there will be a very distinct, and that will show the market that the Fed will be high, will be leaving the rates higher for longer. And if the Fed lives higher for longer, what will happen with the USA is that a lot of people will be looking to buy the US dollar or the US yields and so forth. So we would be having a lot of capital flows inside of US dollar. And once there is a capital flows inside of US dollar, it's basically the demand curve. Okay, so if we get let me get my pen. Let me get a square, something like that. We'll be doing so here and here. So here we got D for demand. Let me change the color to white. So on this one we got demand, and here we got the, let's say, the supply. So higher the supply is, higher the prices of the demand has to be. Okay, and at some point we would have an equilibrium point that we call the E key. Okay, so that's where the buyer and the seller pretty much they meet and they say, look, I think $10 is, I don't know, for a cup of tea. All right, I think $10 is more than fair for me to buy this cup of tea. And the seller is going to be like, okay, so I can sell it for you to $10 because I still have some 20% margin on top of that, so I can keep $2 in profit. Cool. So they have an equilibrium over there, and that's where the sale is made. Okay, so done. Okay, so that's basically what will happen with the US dollar. So if the US dollar, but now just changing a bit, let me take this off. So if the US dollar, if the rates, sorry, have a higher possibility of maintaining higher for longer, then the demand will seek higher yields as well, and they will be met into a higher point, and that will be again the EQ point, equilibrium point. Okay, you can have lots and lots of equilibrium points, but then the chart will become a little bit more stressful. You know, like you could have another equilibrium point here. You could have plenty of other equilibrium points, maybe another one over here and here. So it's too much, but I think you guys got what I mean, right? It's quite simple to understand that if there is a higher possibility of the Fed maintaining, or not only the Fed, but any other central banks maintaining the rates higher for longer, you would be thinking as an investor, okay, so these people will maintain the rate higher for longer. So most likely, I will be maintaining the rate. I will be maintaining my money with them, and not with RBA, like we did today, that is cutting the interest rates and are planning to continue to cut by 25 base points until December. Okay, because your money will be worth much more in these last oh wow, we're already on 8 on these last 4 months of the year. Okay, so that's pretty much it. I think you guys sort of got it, what I mean. Okay, cool. That being said, do you guys have any questions about it, or can we move to the next one? No questions? No? Okay, that's great. Okay, so yeah, no questions. Cool. Based on that, then, what could we trade if it comes above or below expected? There's a few things here, and it's pretty simple actually. I would say it's one of the easiest trades we could ever have in the whole year so far. Having like this is one of the actual, like, not joking, it would be one of the best opportunities to trade in the market for this year. It's really easy, and it's like really on top of everything. So if we have a higher release, okay, let me just type that down for you guys. Let me go here. So higher release, equals to higher yields, that will be equal to higher US dollar, that will be equal to, long USD. Okay. So if we got a higher release, then we're just going to be looking to long US dollar. Okay. Now, if we have a lower release, release that equals to lower yields, and that equals to lower USD, and then we would be looking to short US dollar. Okay, so that's pretty much it. So that's the chit sheet if you guys want to have a look into it. So higher release, if the CPI comes in above, so there's two main points here. Let me just bring this to that part. Okay, this one down here, this one out. Okay, so if we have this other one, if we have above, actually, let me type that into, there you go. So above expected is one thing, and then we have another thing that will be above previous. Okay, so we have these two options. Above expected will be I would say an mild, like a low to mid move. Okay, it would be like low to mid move. If we have an above previous, then we're going to have a high to huge move. Okay. And why is that? Well, it's quite simple to understand. If it's above expected, then okay, cool, that's it. It's only above expected. If we have an above previous, then it will be huge. Okay, because it's above the expected plus above the previous. And then this will occasion that the Fed CME tool will be much more precified to be into the rates. Okay, and that would be, of course, long US dollar. Now, if we have a lower release, that would be pretty much the same. I don't think I can copy that. Yeah, I can't do that. But anyway, so I can just redo this again. So here, if we go below expected, that would be 1, and we can go below previous. That would be another 1. And from there, and from there, we have another 2. So from here, below expected would have a low to mid move. And here we're going to have a high to huge move. Perfect. Now, that being said, just making sure you guys understand that if it comes lower, we're going to have a short US dollar setup. If it comes higher, we're going to have a long US dollar setup. But that can be, I would say that can be strengthened in a sense. If we have a higher release, but that's above the previous, that will be even more move. It would be like a huge move long US dollar. If we have a lower release and that release is that release is below the previous, then we're going to have a huge move down on the US dollar. Okay, does that make sense? Do you guys want me to explain more in depth or anything?
Hello, can you please repeat? I didn't get.
Sorry, say it again.
I'm like, can you help me repeat?
I
My network cut out.
I can't hear you very well. I think it's better if you type into the comments. That will be better.
How about now? Can you hear me?
Yes, I can hear you. Yes.
Yes, I'm sorry about that. My network cut out. I didn't hear anything you said. You were talking about. what when CPI comes out higher or lower, the minute you're cut out, the question you repeat.
Okay. So let me see if I understood your question. Basically, what would happen if the
Yes.
rates would be as expected? Like there's no changes in a certain way.
No. You are repeating. I'm requesting you repeat whatever you're saying because I didn't hear. My network cut out.
Yeah, please, if possible, type on the chat because it's a bit of a noise for me. So if just type on the chat for me so I can understand your question a bit better. Okay, so let's just continue and wait for KC question into the chat so I can move forward. But yeah, okay. So that's pretty much it. If you guys want to take a screenshot, feel free to do it. Not a problem at all. Wow, we got so many people here today. And also, there you go. Please repeat because my network went off while you were explaining. Oh, okay. Okay, cool. No problem. Yeah, so basically, if we have a higher release on the CPI and that is above the expected, we're going to have a sort of like a low to mid move. But if the release is above the previous, we're going to have a huge move. Okay. Now, if the release is lower than the expected, so below expectations, like the consensus, the forecast, different economic calendars have different sort of phrasing, but it's all the same thing. So if it's below the expected, then we're going to have a low move. If it's below the previous, then we're going to have a huge move. So it's all about, is it below or above consensus? Okay, that's okay. That's not that bad. But if it's below the previous or above the previous, then we're going to have a huge move. Okay, cool. I think I made that clear now. What I will do is I will also take a screenshot and send that into the Telegram. Okay, so you guys can have that on the Telegram. So I've basically going to take this as a screenshot and send it there, and I would try to type a little bit. I think I've made that clear, but I would try to make it even more clear into the message on the Telegram. Cool. Now let me delete all of these and let's go for the trade setups. And let me take this off as well. Okay. So USA CPI, cover it. Why is this release particularly so important compared to other ones? Cover as well. And what can we trade if it comes above or below expected? So let's go first with DXY in itself. If that comes above, let me go for a slower time frame. If that comes above, most likely what we're going to get is, as I say, a low to mid move above the forecast, a low to mid move. And that would probably break the top of $98,700. I do believe that would come above. Okay, I know we got the NFT from 2 weeks ago. That is some sort of release, a smaller release in a sense. It's 70,000 now, but I still feel like that there is a lot of spending because the PMIs and the GDP is still growing, so most likely will be a spending into the economy, and this will drag inflationary pressures. And if there is inflationary pressures, then there is higher yields for longer, and this price of the CME FedWatch tool will be repricing itself. So from 86.5% chance of cutting, that maybe can come down to 40, and then they stay the same, so no changes would come from 13 all the way to 60%. Okay, so there is a chance of that coming higher than expectations. If that's the case, then what we would be looking is a break above the 98,700. Just put that 700 here. Perfect. And we can go all the way, even maybe up to 100 again. Okay, this is exactly what I mean. It's one of the most important release. So make sure to be trading this because it's as I say, it's one of the easiest setup that you can get into the market this year. Now, if it comes below, I really don't believe that we may have a continuation of below 98. And the reason is quite simple. The Fed is already expected to cut 50 basis points, as I've shown you guys. So if they come below the expected, that's it. It's already priced in, and it's priced in quite a lot, right? So it's 86.5%. And then for September and October, we have a 52%, 52.4% possibility of cutting again. And then in December, we have only 0.3 difference from 42.9. Yes, 42.9 to 40. Oh, that just changed it, because in the beginning it was 43.3. So that just changed it. So that's 0.7% now of difference. Interesting. Anyways, so if that comes below, then yeah, that's it, came below. This won't have any changes, okay? And I think that would be pretty much it. So pre-prejudice saying that what I'm thinking, the price is going to go back to 100. That's what I'm thinking. The price is going to go back to 100. Yes, I believe, and I believe the same as you. We have this huge candle down here that some of people call that imbalance. So there's no prices. If we look down here, there's no prices that actually come back from the price of 99,400 all the way up to 100. So most likely we even have a break above 99,400 all the way to 100. That is a possibility. I don't see much downsides here. Now, that being said, now we need to couple that back, because we can't trade the US dollar index. Now we need to couple that back with the FX pairs like euro, pound, CAD, Japanese yen, etc. For those who remember, we did had some quite good trades from last week. So we get a good trade on the Aussie dollar. We had a good trade on the euro dollar. That it's already, I think I've took off already. But anyways, we caught all of this long move here. But I do know yet I can predict. Yes, we never can. And the GBPUSD, we also had a really, really great trade from last week. Just a second entry here. Let me just reduce this one. Just this second entry, we weren't quite able to catch it for a few pips. It was like 4 pips, was really minimal, but we still got 150 pips take profit from this swing trade here. So it was quite great in a sense. US dollar, Japanese yen, I still have this position sort of pending, and that's exactly what we're going to talk now. So let's go back to euro dollar. I do believe that as I say, inflation will come above. So this will drag US dollar all the way up to 100 again, the DXY. And euro dollar, as you know, I've been explaining this quite a couple of times, most likely will be going down. So we have euro as the base, US dollar as the quote. So if the US dollar is on the quote and the quote currency is strong, then we're going to have a bullish move on that currency that will result into bearish move into the base going down. So I do have a few targets already in mind. So the first one, of course, would be the 1.15700, and the last one would be the 1.14200. So let me just correct that. 114,200. And let's put this one into green so we know it's a target, and this one as well. Green. And the coordinates would be 600 here. Perfect. And as you know, as always, as I've always mentioned, and I will keep mentioning, it's all about that's the way I've been doing for years now. It's all about, if you look at the chart, there's always these boxes, right? Sooner or later, there will be a fill. Okay, so the market will sort of come back, like this one as well. The market was going back to that area. So it didn't have quite the strength, but maybe in the future, I don't know, but maybe it's in the next 3 months or something, the market can come back and revisit these areas. So it's exactly, if we just look back, there's most likely boxes right here that the market went down and got as target. So this one being the first one, this one, so the market came back, reached this one, retraced it, did a sort of like accumulation again, get back down to the price of 114, 115 again. So there's always targets. Like this one was the third one again. So there's always targets. Okay. Cool. This would be my favorite trade. So this I'm still expecting a bit of a pullback going into London session. If we get a Fibonacci 2 from the top here, from the top here to the bottom, I'm expecting at least a 50% pullback, and that's coupled with some sort of like a support that was a support now turning into resistance area around 1.16400. So I would place my position, entry position here. Let me go into short. My stop loss would be above the 61. As I would be looking to trade the release, I don't want to have a huge position. So just keeping that simple and don't do any, swing trading. Don't do any swing trading. That would be my sort of ideal idea for tonight. And my take profit, ultimately, of course, I would be targeting 114,200, as I say, but would definitely be taking 50% off of my position and placing the stop losses at break even for 1.15600. Okay, so as soon as we get at this point, I'll be reaching 50% or maybe 60% of the position, and then just sort of trailing stop the position down to 1.14200. Okay, so it depends. So this position, there's a few things just to add before we move to the next trade. This position, I would say, first, if we get triggered before the release, would be more ideal. So the release will be at 10:30 p.m. Australia time. As you can see here, 10:30 p.m. Australia time. Just make sure you change the time zone if it's already not automatic to your time zone. But if the position don't get triggered before the release, then we would need to check about the spreads. As you know, majority of the time, 100% of the time, when we got CPI, when you got NFB, when you got central banks, the spread get wide. Okay, because market makers don't want to take the risk, so they just step out. And the quotes providing to the market, it's a little bit of more wider quote. For this reason, the spread, the bid and ask difference will be quite maybe higher, maybe 2-3 times higher than usually is. Sometimes it can be more, and there's a lot of slippages that can occur. So what I would do is I would wait for the release. Okay, I know it's we may be mixing the best price of entry, but I would wait for the release. 30 seconds after, the spread will probably get back to normal, and then I would enter into a short or what the price is. Most likely the price would be below here. So what I would be looking to do is, okay, let's say the price break the level of 1.50, 1.16. Stop losses would be the previous high. Let's say the previous high would be this one, or maybe it can be a little bit higher. And then I would still target my target at 1.14200. It's still really good, really good solid trader, 168 pips compared to the stop loss of 46 pips. So that's basically 3.62% at 3.62 times. So that's awesome. Okay, it's a good trade. So these are basically my two concepts about euro dollar short. Now moving on, the next trade would be the US dollar Japanese yen. So the US dollar Japanese yen, we had a few big moves in the last couple months, but when we look to a daily chart, okay, let me just delete all of the drawings. Oops, sorry. And we go to a daily chart, we can clearly see that we're not going anywhere since April or even March, if you want to call it. Okay. So since I would say since March, we haven't gone anywhere. We then all the way up and all the way down, and now trading at, again, same price as we were at beginning of the 2025. Even if we just put a little bit more on February. So I do believe that there's a couple reasons for that. The first one is that Japanese yen is trying to be stronger, okay? Because when we look back, We had very, very weak Japanese yen since 2013, down, all the way up to 2024 last year. And then we had a switch of the Bank of Japan the Bank of Japan chairman that is a little bit more hawkish, but still not enough to make the Japanese yen stronger for, all the markets and all the all the participants looking to buy and sell the US dollar. So the Japanese yen is into a transition from a very bearish currency to a minor bullish. So it's that little baby that it's growing, but we still have a lot of time to develop. It doesn't even know how to talk yet. It's just murmuring around. So for this reason, it's very, very sensitive. So anytime we have a strong US dollar, anytime we have a strong US dollar, we have a really big move into the US dollar Japanese yen. I've just overlay here let me just put this in line as well. So I've overlay in pink the DXY, and it's in yellow, it's a US dollar Japanese yen. So what I want to show is the difference between US dollar and the Japanese yen. So if we look, there's no big difference, okay? So there's times that the Japanese yen is much, much more stronger, but soon enough, the US dollar is not that weak, okay? It's really not that weak. For the whole move that Japanese yen did, US dollar only moved a couple of dollars. And then when US dollar is strong, Japanese yen loses a lot of strength. So it's very, very sensitive. I hope you guys sort of got what I mean. And based on that, being sensitive currents, any release that favors the US dollar will have a higher probability of the US dollar Japanese yen moving up and fast and very strong. Okay, especially after those huge moves tends to happen a reversal patterns. So we had a consolidation here in the last couple, I would say couple weeks, since beginning of August, pretty much, and we've been able to broke the top of this consolidation of 148. Most likely, what we're going to have is a retrace back to 148. All right, so let me change that to white. Put this 148 here. Perfect, and then if the release comes in higher than expected, we will be looking to break the levels of 150. Okay. So if we have a pullback at 148, I would be looking to be a buyer. Okay. I would be looking to be a buyer. Let me just get the long position tool. Targeting 150. And my stop losses would be just below this low. Okay. Again, ideally would be better if we get into this position before the CPI release. Oh, why you just don't get in now? Because if I get in now, still my risk reward won't be effective as if I just wait another couple hours, So I prefer to wait a couple hours and get around 50 pips more for waiting, like as a reward of waiting a couple hours, than get into the market right now. Lots of things can happen in 2 hours, especially when we're leading with Bank of Japan and the Fed together. Out of nowhere it can happen a market operation from Bank of Japan or something like that. So just wait. It's a better approach, into my opinion. So 148 would be my entry trigger. 151 pretty much would be my take profit, and my stop losses would be just below this low here before the market take off. So in my opinion, okay, yes, you can definitely put the stop losses below here. You still have a 1 to 2 trade. So you would be looking to 146 pips stop loss and pretty much 300 pips take profit. So very, very close to 1 to 2. But in my opinion, from here, it's where the actual buyers got into contact with the US dollar and selling Japanese yen, because that's the last move that made the whole the whole structure crack in a sense. So I do believe that I'm pretty well, supported by the buyers below the level of 147,350. So that's where I would be placing my stop loss. Okay, and then as I say, my take profit nearly very, very close to 151. And that gives us pretty much 2 times 1.87 times if we place our stop losses below over here. Okay, cool. Now, does anybody have any questions? So these are pretty much my 2 favorite trades. So just going over again, euro dollar short. Sorry. Actually, let me leave this one over here. And let me add another one so you guys can see both of them. Perfecto. There we go. Okay, so these are my 2 trade ideas. So ideally, I would be looking to catch this trade before the CPI release, 10:30 p.m. Australia time. So looking for the market to go up and catch my entry at the close to the 50% of the Fibonacci retracement from the top of 117 down to the bottom of 116. Close to 116. And so just a small pullback to 50%. Stop losses would be above the 61. And my first take profit would be at 115,600. And then the next take profit, my last take profit, and then close the full trade would be at 114,200. On the first one, I would close 50% of my position and then move the stop losses to break even. Okay, and of course, in the end, it would be 100% of the trade closed, so we wouldn't have anything else to do. Now, if we don't get to go into the position before the NFP and we were, for some reason we missed this trade, there's always a second opportunity of us waiting of the break of this low. Then the market pretty much showing me that yes, okay, there is a selling pressure into the euro and the US dollar is looking to go long again. So the market is pulling back down, putting pressure into the euro. So there, I would just follow the market. I wouldn't try to go against it. And then that's where my second position entry, I would say, criteria we get in effect, and I would enter into 1.5900 with stop losses above the previous high. That would be this one. I would say it's a small pullback here from 116 to 116,200, pretty close. Anyways, and then my take profit would be at 1.14200, and I would look to close 50% of the position when we have a break below the 1.15300. Okay, let me just 1.15300. There we go. And then move stop losses to break even and wait for the trade to get fully closed. So these are my 2 trade ideas for euro dollar. Now moving on to US dollar Japanese yen again. This one I would say don't really have a second sort of criteria for this trade. If there is no trade possibility of the market pulling back down to 148 and just get us, a good entry, I would just leave that, because euro dollar would definitely give us an entry. If it's, on the pullback now before, or if it's the move after, we would chase the move in a sense. Don't go against the market. I think most likely we would be able to succeed in one or another. Okay. So now for US dollar Japanese yen, I was going to be looking to wait for the market to pull back at 148. That's where, there's a few points that break down here, but the actually extremist point of the consolidation was at 148.100. Okay, so if we get a pullback between those 2 lines, 148.100 to 148, I would be happy to enter the market and then just wait for the CPI release. Stop losses would be just below the previous low, where before the whole move, sort of break above the consolidation. So I do believe that there is a lot of long positions being sitting down here, and that would be like a safe spot for me to place my stop loss, and then my take profits would be above all the way on the high, especially after this huge long candle here. Okay, some of the people call that imbalance. I just call that there is, a huge candle here. Most likely, especially on US dollar, Japanese yen, we always get to feel those after these huge moves, and I think I've showed that to you guys already. But like something like this one, going all the way up, and then after that down, going all the way down here. Took a time, but went all the way up again. So there's always that sort of data playing with us as well. Cool. Now let's just come back to the finishing webinar. So now you know why this release is particularly so important compared to other ones, why this CPI is particularly important compared to other ones. And it's basically because the Fed is really, really, really priced in to cut. And if that release comes in above, that is what I believe it will, then the whole switch will be happening on the market, and the US dollar from bearish will be turning really, really bullish. And there's definitely really great opportunities, as I just say, euro dollar down and US dollar Japanese up. Now, what could we trade? As I just say, euro dollar down and US dollar Japanese yen down. Do you guys have any more questions before we close? Oh, wait a minute. We do have a few questions. Your euro dollar setup is if setup fail to trigger, we sell from market price after the news release and take TP at 114. Yes, that's my second trade idea. That's correct. Zodwa Della Australia, they did cut the rate today, and Aussie dollar is weak. Yeah, that's correct. As the market is just following its natural effect. So RBA, the Reserve Bank of Australia, Michelle Bullock did cut 25 basis points today after, from last meeting. I don't know if you guys remember that. But the RBA rate tracker, that is the tool that tracks the possibility of rate cuts from the RBA, was widely priced in. I think it was 80% priced in for cut. And that didn't happen the last time. So they deliver it now. So, we can talk about that tomorrow, because today was more focused into the CPI and sort of the week ahead based on the CPI. And as I've mentioned at the beginning for you guys, so the expectation was already on top of that. But as I say, tomorrow we can talk more about the Australian dollar. But yes, there's definitely a possibility of the Australian dollar continue to weaken to December, and especially after after her say that there is more possibility of them continue to cut 25 basis points. So it's good for landlords, for the mortgages. But let's see how this will reflect into the economy. It takes a bit of time until it gets reflected into the society. Cool. All right. With that, I close to today, and we'll be back tomorrow. So thanks for all of the 14 people that came here and to listen to me for an hour, pretty much an hour and 10 minutes now. If you guys, again, have any questions, we'll be sending the image for a cheat sheet on the Telegram, and we go from there. See you guys back tomorrow at 4 to 5 p.m. Sydney time. Have a great day, and have a great trading as well. Cheers, guys. Bye-bye.